Hello, today we're going to go over the statement of cash flows, and I'm going to do the direct method, and that seems to cause some problems. But remember, the statement of cash flows has three sections for it. It's the operating, investing, and financing activities. And the way I remember it is OIF, because we always remember OIF. So if we know how to do this, we'd be all set. And so it's operating, investing, and financing. Now I have some information. I have two spreadsheets up here. This is the information page over here. We start with the income statement and then the balance sheet for 2 years, 2016 and 2015. And then down here is a little bit of additional information that we will need. So I have over here, this is the statement of cash flows. Of course, this is what we're going to be filling in. And this page is my calculation page. So I always start with the income statement. That's the easiest place to start with, because we want our cash collected from customers, because the operating activities is the one that gives us the most problems, I think. So we start with the first thing on the income statement is right here. The statement of cash is the total revenue, which I should take that up a little bit, right there. Our total revenue. So we'll put the total revenue right here, 17,650. And then what does revenue affect? Well, when you sell something, you usually go through the accounts receivables. Okay. Now what I also will do over here is I'll type a little OK there, because everything on this statement has to be accounted for when we're done. So on the income statement, revenue goes through the accounts receivables, and we have a beginning accounts receivable, which is 2,200, and then we also have an ending accounts receivable, which is 2,500. Now we want, how much did that change? Well, that changed $300. But is that $300, did we collect it or not? Well, since the accounts receivables went up, we didn't collect it, so we subtract off the accounts receivable. Now the other thing that affects revenue is the unearned account. So over here on the accounts receivable, we can put OK, because that's done. And then we have down here the unearned revenue. We have a beginning of 600 and an ending of 800 for a difference of 200. And since unearned revenue increased, that means we received the cash, because that's what we're after, is the cash received. And that's 17,755. So over here on the unearned account, we can type in OK. Like I said, everything has to be accounted for when we're done. Now I have this already set up over here on the statement of cash flow. So you see 17,550, it's already populated over here because I have it linked. Okay, then we go, next thing on the income statement is the cost of goods sold. Well, that is for 7,200. Now where does the items come from? Well, they come from inventory, right? So we look at a beginning inventory of 3,000. Ending is 4,000. The change of 1,000. Well, we're looking for how much did we purchase. Did we purchase more or less than we sold? Well, since inventory increased, that means we purchased more, so that's why we add it. Now, the purchases will go through the accounts payables. Okay, so over here in inventory, I better keep this current. That's okay now. The accounts payable, the beginning was 1,100, ending was 1,400, difference of 300. So did we pay that 300 or did we keep the 300? Well, it increased in the payables, so we kept it. So that's why it'd be subtracted off. And we'd mark OK on this one. Then what we would have, payment for expenses, selling expenses, is 2,400. That's given off of the income statement. However, we go down here to additional information. It says depreciation of, it should be, I got to change that, of 1,600 is included in operating expenses. Well, that means we need to subtract off 1,600 here. It doesn't matter which one we take it off of. I just took it off of that one because I wouldn't forget it. So over here then, so payments for selling expenses would be 800 that we have listed, and that's what I have over here. Okay, so the selling expenses, Oh, I didn't get these caught up, have I? That's okay, and that's okay. Okay, general administrative expenses. That's 1,500. Okay, so we'll have that one okay, because we want to go through all the expenses. And now the thing that'll affect those expenses will be the prepaid accounts. So we look on the balance sheet and we have, of course, a prepaid account, a beginning and an ending. So that's 300, that's 150. So that makes that one's accounted for. Now, prepaid went down. That means we did not replace what we used, so it would be subtracted off. So that'd be 1,350. And prepaid's okay. See, we don't care about totals. Interest expense is 200, so that will go here. And so that's now accounted for. And over here we have interest payable someplace right here. Started out at 0, went to 100. Okay, so here we have 0, here we have 100, which means we did not pay it, so we only paid $100 on interest. So that's okay. Okay, as I said, it's easier to keep things, like I said, totals I don't care about. Income taxes, that's the next one on the income statement, because everything else has been accounted for except for the income tax. Now keep in mind, this 1,600 is the depreciation expense. That did not require cash. What we're looking for is cash payments only. That's why we subtract it off. The income tax was 2,500, I believe. Yeah, there it is. So that's okay. And then we have the good old income tax payables. And we have a beginning and an ending. So we started off with 800. We ended up with 150. We paid extra of 150. Well, we can do it this way if you don't want. We paid extra. You take 800 minus the 550 of 250 extra. So the 2750 should be over here. Okay, so this is all filled out now. So net cash provided or used by operating activities is 4650. That's provided by because it's not in parentheses. If it's negative, it's used by. Okay, that is the, now we look at up here, and we should have everything on the income statement is accounted for. Like I said, these are totals. I don't care about that. That's a total. That doesn't count, and that's a total. So that's okay. Now, we come down to the balance sheet. Plant and equipment. Well, went from 12,000 to 14,500. Well, that kind of gives us the information down here. Because here it says the equipment costing $4,000 was purchased with cash. So since we paid cash for it, we can just put in the $4,000. Now I do have some T accounts over here. I should have my beginning balances in there. We start off here with 12,000, and the accumulated depreciation was 4,500, I believe. Yeah, 4,500. Okay. Well, it says we purchased 4,000, which makes this one then 16,000. That's what we have in the account so far. But what else did it tell us? Okay, that's part 2. 3 says equipment with a book value of $500 cost $1,500 less accumulated depreciation of $1,000 was sold for $500. Well, here we would have an income of $500 coming in. Oh, I got those in the wrong line, didn't I? Okay, try this again. Minus 4,500. That's better. Had the wrong line there. Okay, so we had, that's 3,500 then, because we paid 4,000 out in cash and we received $500 in sales. So that's okay with that one. And then it said we sold 1,500. I always like doing this to make sure everything balances. So we take this one, the 16,000 minus the 1,500 gives us 14,500. And over here it said our accumulated depreciation for the year was 1,600, and we sold $1,000. So we can have equal this one minus this plus that 6,100. 5,100. So if we look on our balance sheet, right here. That's now accounted for because that's the balance we have, and we have 5,100 in the, okay, so this is all accounted for. Loans, when you borrow money or pay money back, it is for financing activities. So receipts from loans, if we look at our loans, we were from 0 to 5,000. So I think this should be actually, you got to change that to 16 or maybe even 17. I don't know. Yeah, 17. It's due next year. In payment for dividends, it said we cash dividends of $1,000 were paid. So that's $1,000, and helps put 1,000 in, not 100. Okay, $1,000. And now we look at, so now over here, that one's accounted for, that's accounted for, that's accounted for, and our cash, 2,200 was my beginning balance, 7,350 is my ending balance, so everybody's happy. Okay, how about retained earnings? I didn't do that one. Well, we start with retained earnings. Let's just kind of go through it here. So I'll just put R/E. My beginning balance was 2,700. I added net income of 3,850. Oops. Got to come over here. 3,850, and I subtracted $1,000. I'm about to subtract $1,000, which means I have 5,550 in the account, so it is now accounted for. So everybody's happy. Okay, so that's how you account for that. Everything needs to be accounted for. So now we can put a little OK on that one because it's accounted for as well now. Okay, that is the statement of cash flows. Now when you do the direct method, however, you need to go through and you have to make your adjustments. You start with, this is the indirect method in essence. So you start with net income of 3,850, add back in any expenses that did not require cash, which is the 1,600, and then you go through your current receivables and current payables that are operating activities. So we have an increase in receivables. That would be a minus 300. That's a use of cash. Increase in inventory for 1,000. That's a use of cash. Prepaid rent went down, so that you kept the cash. Accounts payable went up, so you kept the cash. Interest payable went up, so you kept the cash. Your unearned revenue decreased, so that's that you didn't, or increased, I should say. And then you have a decrease in your taxes payable. So you notice this number and this number is the same, and I'm going to rename that because I changed that to unearned revenue, because that's what deferred revenue is. But when we're done, this number and this one needs to be the same, and in this case it is, so everybody's happy. Okay, that's a very brief, very simple statement of cash flows, and hopefully this helps you. So that should do it.